One thing
Likewise.
that occurs to me is that our discussion of tariffs is pretty unsophisticated. I think American companies and retailers have, over the last 20 years, gotten very sophisticated in their pricing models. We have lots of information available. Retailers scan the web for their price points that their competitors are charging for things, and they've essentially gotten to the point where they can charge the maximum price that the market will bear. And that's been there for 20, 15, 20 years. So we're not doing cost plus pricing anymore. And a lot of classical economics are based on this idea of cost plus pricing. And if you raise the cost with the tariff, obviously the prices have to go up. But if you're already charging the maximum amount that the market will bear and your costs go up, you're either going to sacrifice share or
Right.
you're going to have to give up some of your margins. So
Well, that's the point, is the second one. This is very consistent with classical economics. Classical economics does not state that it has to move on to the customer because the inelasticity of prices sometimes will not allow it.
right,
And that is true regardless of the mechanism by which one gets to price discovery, the cost plus model or not. The issue is whether or not we think it is good for the US economy for the companies to eat it in certain cases. So we are going to find out that there are a lot of products that have tremendous price elasticity and they will see price escalation. And there are a tremendous amount where they will have to maintain market share, as you wisely say, and not pass it on. And it is that latter that I believe the administration is going to rue. It is not going to be good where corporate profits are compromised if we have vulnerable labor markets, if we have declining industrial production, manufacturing, capital investment, durable goods orders, et cetera. Those elements are all contingent on a profit foundation that is driving further investment. We're already going to have to deal with the reality of less foreign flows because the current account deficit is going to decline, and that this is just pure mathematics. And so I think that what you're talking about is just the other side of the coin, but both sides are negative for economic growth, other than the element Mark brought up, which is where we get new markets opened.